Hi everyone, Aidan here for another iStrategic Weekly Insight for Friday the 24th of July. The easy money has been made, or has it? What I'd like to do this week is dive into the latest Cotality Housing Data for this month. We look at national trends, we look at some capital cities versus regionals, and it's a good litmus test for how the real estate market as a whole is going. So I'm going to share my screen, just jump straight into it. So the first interesting point that I talk about in my newsletter is that the amount of auctions, the amount of properties going to auction has dropped from a height of 45% in November down to around 30% in June. It's important to understand that the long-term average is actually around 28%. So that's kind of actually more where the long-term normal is, I guess. So basically what it means is with all the uncertainty that we've had going on, policy changes, etc., there's fewer vendors who are willing to risk taking their properties to auction. Now, I personally don't love the auction statistic because it tends to be heavily skewed towards Sydney and Melbourne data. And as we know, they're the biggest populations, and therefore they tend to weigh heaviest when we look at aggregating the entire property market into one number. So moving on, I really like this chart. Residential real estate underpins Australia's wealth, understanding that residential real estate in Australia is worth a total of $12.5 trillion. It's far larger than superannuation and the ASX combined. And there's only 2.6 trillion in outstanding debt, which is a very low loan to value ratio. All right, headlines for the quarter and the month. Over the last 3 months, the national housing value number has decreased by 0.7%. Now, the 12-month trend is still positive, but the rate of growth has decelerated, and we're now down to 7.3% over the year. Very different story between combined regionals and capitals. The combined capitals have lost 1.3%, or they've gone backwards 1.3% in the last quarter, while the combined regionals have increased in value 1.1%. Here we can see the data, particularly on the right. If we have a look at the dark purple, that's combined regionals. You can see both markets have decelerated, but the combined regionals are still in positive territory above this black line of the zero amount. Combined capitals have gone down or decreased 1.3%. But over on the left, you can see it's a really diverse story. You know, Sydney and Melbourne have gone backwards 3.2 and 2.6%, but you got Darwin still screaming ahead at 5%. You got regional WA 3.7, regional Tassie 2.8. So as always, it's a really different story depending on where you're looking. Here's the 12-month data. Excuse me, you can see over here on the right, combined regionals have grown by 11% over the year and combined capitals 6.1, but you can still see that both of them prices have started to decelerate. Oh, and another huge divergence. I mean, Perth has screamed ahead 23.9%, Darwin 19.8%, Brisbane 17.4%, while Melbourne's gone backwards a little bit and Sydney's barely moved. Again, huge divergence. I'm going to skip through a couple now. I really like this one. This is capital cities by value segment. Now, what does this tell us? Basically, the highest end, the most expensive quartile of properties in each market is moving the worst. So I'll say that another way. If you look at Sydney and Melbourne, the price declines have been strongest in the higher end of the market. You can see that the cheaper end of the market has been the most, where the least declines have been. And in the smaller capital cities where the growth is still positive, it's been strongest in the lower quartile. In other words, the cheaper and the middle end of the market are the most resilient and performing the best overall. Okay, here's the rolling 28-day price growth. You can see of the top 5 capital cities, it's all trending in one direction. They're not all in the negative, but Sydney and Melbourne clearly are below the zero line in the negative, but the growth has been decelerating. Okay, skipping through the individual capital cities now, I want to get to a couple of other data points. Sales and listings. So national home sales rose 2.1% over the year to June 2026, with growth concentrated in regional markets. The number of sales across the combined regional areas increased 7.2% year on year, while the combined capitals eased 0.7%. Okay, we're back to around, if you see this chart on the right, back to around or just below the 5-year average in terms of the amount of sales volume. Median days on market, which is an indicator telling us how long it takes to sell a property on average. You can see on the right here, that's ticked up both for the combined capitals and combined regionals. It's still fairly acceptable with 36 days on market, the average for the regionals, and 30 days on market, the average for the capitals. They're not bad figures, but they're softening. We can see the demand is softening. Okay, total advertised. Well, we'll talk about new listings, listings by region. New listings in the capital cities are 2% higher compared to last year. Most cities have seen an increase in the flow of freshly advertised stock relative to a year ago, although new listings in Sydney and Hobart are down 8.2% and 9.6%. Again, huge divergence. You can see new listings change from equivalent period last year. Perth is up, Hobart is right down, regional Victoria is right up, regional Tassie is right up. Total listings, the change from, so this is new listings on the left and total listings on the right. Total listings are right down in Hobart. They're very strong in Brizzy, telling you there's more supply coming on the market in some of those areas. Some of them way less, Tassie, regional, WA, etc. Clearance rates. All right, clearance rates have peaked, and as we can see, they've been declining for quite some time now. Okay, rental market. I want to skip to that. Our rental, so the growth in rental prices year on year is still pretty strong. It's 5.9% on average, but you can see big divergence in some of the markets. Regional Tassie rents have grown the strongest, 10.1%. Regional WA, 8.1%. Darwin, 10%. Hobart, 8.6%. Perth, 7.8%. So still very strong rental growth year on year for most markets. They've been above inflation, and some of them quite a long way. I'd like to go to dwelling approvals for a moment. Now, we have two things we look at. We have units dwelling approvals and houses dwelling approvals. The kind of the light pink is units. You can see its decade averages there, but it swings wildly from quarter to quarter. It's down very sharply in May, down very sharply from the February high. No secret, high construction costs, making finance harder to get projects out of the ground. As we've always said, like, if something doesn't stack up commercially, then the developers just don't develop. The builders don't build. And so that's what can cause a really sharp decline very quickly in dwelling approvals. Houses have been a little bit different. It's steadily ticked up, and that's a good sign, I think, with a bit more supply going to come out of the market. So that's what the indicator is there. Again, slightly above the decade average. Finance and lending. This is interesting. It looks like overall we can see a very strong trend over the last few years. We've got in the purple owner-occupier lending and investor lending, new finance commitments. But you can see it's just peaked really recently, and not a sharp downturn, but started to taper off in most of the states. By the way, that can be good from a borrower's point of view. Means you're more likely to be able to negotiate better terms with your lenders if they're vying for competition in a slower market. Investor lending on the right here, we've got the black band is the 10-year average, and the column is March. So the value of investor lending as a percentage of total lending, in other words, in each of the states. We can see ACT is the only one where we're below the 10-year average. Every other state, we're very much well above the 10-year average for investor lending as a percentage of total lending. First home buyer activity, similar, but not as dramatic. We're only slightly above the 10-year average, with some markets being below. So WA and Queensland being just below and a fair bit below their 10-year average. Okay, the RBA held the cash rate at 4.35% in June, but the direction of rates going forward remains uncertain. I think the consensus would be, which would agree at this time, we're in late July, there's probably not going to be a rate cut. There may be another rate rise if inflation continues. However, we probably won't start seeing reductions until there's a real material downward spike in inflation and a real uptick in unemployment, which we haven't quite seen yet. So probably going to be rates somewhere around where they are well into 2027, but we'll see. All right. So my takes. What is my take? I really think what's this data telling us? The fundamentals remain the same. If you're investing in property, location matters, timing matters, asset selection matters. Perhaps more than ever, understanding the underlying fundamentals of each market really, really matters. So for me, that's not necessarily bad news. It means if you're going to invest in real estate, having good quality data, advice, and experience in your corner when making decisions is becoming non-optional if you want to succeed. That's my 2 cents. Thanks for listening. Have a great week.